Hello guys.
Primary market and secondary market. Primary market. This market is also called as the new issues market, where companies/institutions raise funds, capital, from public by issuing new securities, shares, debentures, bonds, etc. There are two major types of issuers of securities. Corporate entities, companies, which mainly issue equity instruments, shares, and debt instruments, bonds, debentures, etc. Government, central as well as state, which issues debt securities, dated securities, and treasury bills. Corporate or government entities may issue the securities at face value, or at a discount/premium, and these securities may take a variety of forms such as equity, debt, etc. The types of issues made in primary market are: 1. Public issue. Securities are issued to general public and anyone can subscribe to them. Public issue of equity shares can be categorized as follows. Initial public offer, IPO. An IPO is where first public offer of shares is made by a company. An IPO can be in the following forms. Fresh issue of shares, where new shares are issued by the company to the public investors. In this kind of an issue, the funds of investors will go to the company to be used for the purpose for which the issue is made. Offer for sale, where existing shareholders such as promoters or financial institutions or any other person offer their holding to the public. In this kind of an issue, the funds of the investors will go to such sellers of the shares and not to the company. 2. Follow-on public offer, FPO. It is made by an issuer/company that has already done an IPO in the past and is making a fresh issue of securities to the public. 2. Preferential issue. In this mode of issue, securities are issued to an identified set of investors like promoters, strategic investors, employees, etc. 3. Rights issue. When the company gives its existing shareholders the right to subscribe to newly issued shares, in proportion to their existing shareholding, it is called a rights issue. 4. Bonus issue. When the existing shareholders of a company are issued additional shares, in proportion to their existing shareholding, and without any additional cost, then it is called a bonus issue. The shares allotted by the company are credited in the demat account of the investor, which is maintained with a depository through a SEBI registered depository. Participant, DP. An investor can sell the shares on the stock exchanges through a SEBI registered stockbroker and receive the money. Secondary market. Secondary market refers to a market where securities are traded after being initially offered to the public in the primary market and/or listed on the stock exchange. Majority of the trading is done in the secondary market. Secondary market comprises of equity markets and the debt markets. For the general investor, the secondary market provides an efficient platform for trading of his securities. For the management of the company, secondary equity markets serve as a monitoring and control conduit by facilitating value-enhancing control activities, enabling implementation of incentive-based management contracts, and aggregating information by a price discovery that guides management decisions. What is the difference between the primary market and the secondary market? In the primary market, securities are offered to public for subscription for the purpose of raising capital or fund. Secondary market is an equity trading avenue in which already existing/pre-issued securities are traded amongst investors. Secondary market could be either auction or dealer market. While stock exchange is the part of an auction market, over-the-counter, OTC, is a part of the dealer market. What is meant by market capitalization? Refers to the total value of all a company's shares of stock. It is calculated by multiplying the price of a stock by its total number of outstanding shares. E.g., Company A has 120 million shares in issue. The current market price is Rs. 100. The market capitalization of Company A is Rs. 12,000 million. Why is market capitalization such an important concept? It allows investors to understand the relative size of one company versus another. Market cap measures what a company is worth on the open market, as well as the market's perception of its future prospects, because it reflects what investors are willing to pay for its stock. Market cap vs. free float market cap. Market cap is based on the total value of all a company's shares of stock. Float is the number of outstanding shares for trading by the general public. The free float method of calculating market cap excludes locked-in shares, such as those held by company executives and government. What is SEBI and what is its role? The SEBI is the regulatory authority established under Section 3 of SEBI Act 1992 to protect the interests of the investors in securities and to promote the development of, and to regulate, the securities market and for matters connected therewith and incidental thereto. What is a prospectus? A large number of new companies FLO'd public issues. While a large number of these companies are genuine, quite a few may want to exploit the investors. Therefore, it is very important that an investor, before applying for any issue, identify its future potential of a company. A part of the guidelines issued by SEBI, Securities and Exchange Board of India, is the disclosure of 23 information to the public. This disclosure includes information like the reason for raising the money, the way money is proposed to be spent, the return expected on the money, etc. This information is in the form of prospectus, which also includes information regarding the size of the issue, the current status of the company, its equity capital, its current and past performance, the promoters, the project, cost of the project, means of financing, product, and capacity, etc. It also contains a lot of mandatory information regarding underwriting and statutory compliances. This helps investors to evaluate short-term and long-term prospects of the company. What is a contract note? Contract note is the legal record of any transaction carried out on a stock exchange through a stockbroker. It serves as the confirmation of trade done on a particular day on behalf of a client on a stock exchange. Contract note describes key details of a particular transaction together with the date, time, price, quantity traded, etc. It also includes a reference number which can be used to cross-check the details of the transaction with the stock exchanges. A valid contract note should have the following details in a structured format: SEBI registration number of the trading member/sub-broker, details of your trades like order number, trade price, trade execution time, traded security and quantity, brokerage charge, details of other service charges, signature of authorized signatory or digital signature in electronic format, bylaws and regulations pertaining to arbitration. What precautions must one take before investing in the stock markets? All investments carry risk of some kind. Investors should always know the risk that they are taking and invest in a manner that matches their risk tolerance. Take informed decisions by studying the fundamentals of the company. Find out the business the company is into, its future prospects, quality of management, past track record, etc. Sources of knowing about a company are through annual reports, economic magazines, databases available with vendors or your financial advisor. If your financial advisor or broker advises you to invest in a company you have never heard of, be cautious. Spend some time checking out about the company before investing. Do not be attracted by announcements of fantastic results/news reports about a company. Do your own research before investing. In any stock,